Good morning. It's Jeffrey Christian of CPM. It's about 10:20 on Tuesday, the 26th of April here in New York. We need to talk about, well, the working titles. I couldn't quite figure out which one to use, so they're both here. Alarmism is always destructive to your wealth, and where gold and silver are now, both kind of important type of things. And let's talk about alarmism. Money supply increases have presaged and predicted 9 of the last 1 bouts of inflation. I was listening on Friday to Jefferson Starship's Blows Against the Empire, a 1970 album, and it's got this great line that I've always stuck with, and it actually is a guiding light, I think, in some ways, for my philosophy of life and investing. There's this line that they repeat, which is America hates her crazies, and you've got to let her go, you know, or else you'll stay. And that's just beautiful because that's the choice. You can let her go or you can stay. But we are now seeing another round of hyper alarmism in the market. Just some of the headlines that you pick up. The biggest recession in history is coming. 80% decline in the stock market ahead. 18% inflation. The Fed has lost control. The dollar is collapsing. Money will be recalled. You know, these statements are hazardous to investors' health if anybody actually believes any of this stuff. And I think a lot of people do, and they get scared. You know, this alarmism has destroyed so much wealth. And the reality is, yeah, we are headed toward a recession at some point. It may be next year. It may be 3 years from now. It's probably not going to be the biggest recession in history because we had a series of depressions, which are sort of mega recessions in 1870s, 1880s, 1890s, 1930s, and then you can go back into history prior to the 19th century and find a whole bunch. It's not going to be the biggest recession in history. It probably won't even be as big as 2008, although it could be. It's going to be a big, but that's our guess. 80% decline in stocks. You know, right now stock prices are off from the record highs that they were at 2 months ago, 3 months ago. They have fallen. They're off about 6% from the beginning of the year. We probably will see a bear market in the stock market, and it probably will fall 10 or 20%, and then it'll pick itself back up and go to new record highs, because that's what it does. 80% decline in stocks, that guy needs to switch to decaffeinated coffee. 18% inflation, same thing. The Fed has lost control? I don't think so. I would rather put my cards on a table with Jerome Powell than some of these guys on the internet who are waving their arms and trying to scare people into buying gold and silver at outrageously high premium. Dollar's not collapsing. It's actually showing some strength right now. And money won't be called in. We are moving toward digital currencies, and we will have national digital currencies at some point in the future. But it's going to be some point in the future. I mean, the White House came out with an executive order last month, I believe it was, asking for various government agencies to look into issues related to digital currencies and get back to them in 12 or 18 months. So it's further down the road. We can stay with titles of rock songs and music. So I worry about investors falling prey to the alarmists, and I sense an increased level of alarmism on the part of these guys. And it may be because they're kind of desperate because a lot of investors have gotten tuned out of that kind of hyper fear mongering. So going back to here, money supply increases have presaged 9 of the last 1 bouts of higher prices, of higher inflation. We have a unprecedented situation that we've gone through with the pandemic and a government-induced global recession. We're coming out of it. Let's see where we go. There are an enormous array of problems on the horizon, and we have to pay attention to them. Staying on the theme of don't let the alarmists upset your morning, the sky's not falling. Effective funds rates are going to rise. They've been 25 basis points for most of the last 14 years. They did start rising, you know, a little in 5 years ago, and then they came back down to 25 basis points. They are going to rise. Interest rates are going to rise. They're going to rise maybe 3% by the end of this year, maybe a little bit higher. They're probably not going to rise to 21%, which is where they were at the beginning of 1980. They're probably not going to rise so high that they turn off economic growth, because the Fed hasn't lost control. It's got not only a lot of control and a whole lot of ammunition at its disposal, but it also has learned an enormous amount about monetary policy and monetary practices over the last 42 years. And it will use that knowledge to try to navigate the ship of the US economy between the Scylla and Charybdis of recession and inflation. And our expectation is that they will succeed in quelling inflation without throwing the world into a massive recession. We do think there's a recession coming, as you've heard repeatedly in these videos, but we think it's several years away, and it's not necessarily going to be induced by the Fed raising interest rates to prohibitively high levels. So the sky's not falling. Now let's talk about gold and silver. Prices plunged over the last 2 days. They had actually come off a little bit. They had come off some from the early March spikes that we saw when Russia invaded the Ukraine. Then they came back up. They came off for about 4 or 5 days, and then the last 2 days they spiked down. They're up a bit today. You know, gold's trading a little bit north of 1900, having gotten as low as 1891. Silver's trading around 2365 as I'm talking to you, having gotten down below $23. And all of that has been inspired by the rise in interest rates earlier and expectations of further increases and further tightening on the part of the Fed. The Fed is meeting next week, the 3rd and 4th of May, and they have indicated that they had indicated for a long time that they would raise interest rates, probably 25 basis points. Now they're saying that a 0.5% increase in the Fed funds rate probably is more likely than 0.25. And the markets have been spooked. And it's not anything specific to gold or silver, and it's no smash down or anything like that. It is across financial markets. Stock market has been hit. Bond prices have been hit. Commodities, except for some agricultural commodities, have also fallen sharply because the interest rates are likely to rise. Again, it's not the actual increase in interest rates, it's expectations in the market of increases in interest rates that is taking financial assets down. And our expectation is that this is an interruption in a longer upward trend. Now, we have been talking about how we thought that there could be a pause in that upward trend in the 2nd and 3rd quarters of this year, possibly even extending into 2023, where the prices continue to consolidate and possibly consolidating at a slightly higher level this year than they did last year, partly because of the inflation concerns and partly because of the war in Ukraine and all of those issues related to what Russia's aggression means on a global international political level, which is very significant in the long run. So we're looking at an interruption, partly because of financial markets' concerns about interest rates, and that's going to last into next week, maybe a couple more weeks beyond that. We have Fed FOMC meetings in 3rd or 4th of May, the 14th, 15th of June, 26th, 27th of July, 20th, 21st of September, 1st and 2nd of November, 13th and 14th of December. We have, 6 more Fed Open Market Committee meetings over the course of this year. And several of them, if not all of them, will be probably see the Fed funds rate rise. And the Fed has indicated that yes, the Fed funds rate is probably going to rise from virtually zero to 25 basis points, up to about 3% or so by the end of this year. We probably will see these commodities markets, including precious metals and the stock market, under a lot of volatility and pressure over the next week or so, leading up to that 3rd and 4th of May FOMC meeting and the announcement on the afternoon of the 4th of May. But it looks to us more like an interruption. There is that issue of a longer pause, and we wouldn't be surprised to see that coming too. And then on a longer term basis, we look at all of the problems that the world's facing, and we think that those will contribute to a continued strong level of investment demand for gold and silver, which will ultimately push gold and silver prices higher, just not necessarily right away. I wanted to talk about a few final points. Jack Dorsey, God bless him. St. Louis's own Jack Dorsey created Twitter, $7.3 billion worth of net worth yesterday, before he got, ostensibly he could take in another 850 million on Twitter. Bishop DuBourg High School. If you're from St. Louis, that tells you everything you need to know about Jack Dorsey's personality. What he's really done is he's a perfect example of something that we always tell investors. Selling an asset is as important as buying one. There's a joke in the gold mining industry sometimes that people say, you're not really a gold miner until you've sold a gold mine. It's a lot of people buy or build gold mines, but it really, to be a gold mining executive, you've got to know when to sell an asset. Jack got out several months ago because he looked at what Twitter was and what it was becoming, and he was looking at the future of social media. And he said, yeah, I don't want to be there any longer. So he stepped down, and he'll probably have an $850 million payday when Twitter is ultimately sold. Another point I would make is don't discount the Chinese economy. Now, the Chinese economy is having a lot of problems right now, and the Chinese political system is having a lot of problems. It's had a lot of problems for some time, and they're getting worse. That said, it's going to be very interesting to see how it all shakes out. And I think it might shake out in ways that a lot of people aren't expecting over the next several years. But on a shorter term basis, don't discount the Chinese economy. It has enormous problems right now, but the Chinese government has enormous resources. It has a tremendous amount of money. It has a tremendous amount of manpower within the Chinese economy, and it has a managed economy, which gives them the capacity to do things that the US government and European governments fail to do repeatedly in addressing economic issues. I do think the Chinese economy is having problems. I think those problems are going to continue, but I wouldn't go with the alarmists and wave my arms in the air and say, hey, this is the end of Chinese communism, this is the fall of Beijing, et cetera, et cetera, et cetera. Chinese have a lot of instruments and a lot of knowledge and capacity to deal with the problems they're facing. The last thing I wanted to talk about is last week we said that we would have an open forum on 18th of May. I am probably going to be traveling on the 18th of May, so we're going to reschedule that to the 25th of May. And that is something that's open for all of CPM Group's clients, including the Retail Investor Program clients. And then we will be having our Silver Online Seminar June 1st, the following week. And backing up, on May 10th, we will launch our Silver Yearbook with an online briefing. And then in late June, we'll have the Platinum Group Medals briefing. That's really all I have for right now. You can go to our website, cpmgroup.com, and read various things, see old videos, read about who we are and what we do, and order some of our reports. I'll talk to you on Friday. In the meantime, please take care of yourself and everybody around you, and be considerate. Bye.